Good morning. Today we are going to discuss about a new topic which is one of the very interesting, current and very favorite topic, that is money, banking and central banking. In this chapter we are going to learn 5 important aspects of the chapter. We have 5 learning objectives. First, we'll define the functions of money, identify the key properties that money possesses, and explain the official definitions of money supply. Second, understand why the financial intermediaries such as banks exist. Third, describe the basic structure and function of the Federal Reserve System. Fourth, determine the maximum potential extent that money supply will change following a Federal Reserve monetary policy action. Fifth, explain the essential features of the Federal Deposit Insurance. Our fourth learning objective is to determine the maximum potential extent that the money supply will change following a Federal Reserve monetary policy action. So here we will be focusing on several things like fractional reserve banking, the Federal Reserve money supply. We'll understand various concepts like reserves, reserve ratio, and balance sheet. First, about the fractional reserve banking. It is a system in which the depository institutions hold reserves that are less than the amount of deposits. As early as 100,000 BC, uncoined gold and silver were used as money, and it is originated when the goldsmith in Greece issued notes that exceeded the value of gold and silver on hand. Then the next concept is reserves. In US, the Federal Reserve System, deposits held by the Federal Reserve District banks for the financial institutions plus the depository institutions vault cash. The third concept is reserve ratio. And what is that? It is the fraction of transaction deposits that the bank holds as reserves. And it is determined by the required reserves, the reserves that the Fed requires the bank to hold, that is the Federal Reserve wants from the commercial banks. Then second is the excess reserves, that is the additional reserves which banks voluntarily hold. Our third focus is on the balance sheet. So it is a financial statement of all the assets and liabilities of any business entity, including the financial institutions and the Federal Reserve System. There are 2 items that you can see on the balance sheet. One is asset, and assets are what is owned, and liabilities, and there what is owed. So, how does a single depository institution react to an increase in the transaction deposits of say $1 million? So for this, to know the relationship between the reserves and deposits of individual bank, let us examine the balance sheet or the statement of assets owned and the liabilities that is owed to others for a particular depository institution. The balance sheet of 15.1 in this slide displays a balance sheet for the depository institution, assuming the name of the bank is typical bank. The liabilities for the institution consist of 1 million in the transaction deposits, assets of $100,000 in reserves and 900,000 in loans to customer. The total assets of 1 million equals the total liabilities of 1 million. Because the typical bank has $100,000 of reserves and 1 million of transaction deposits, its reserve ratio is 10%. Thus, typical bank is a part of system of the fractional reserve banking in which it holds 10% of its deposits as reserves. Using the fractional reserve banking, the Federal Reserve can add to the quantity of money in circulation by bringing about an expansion of deposits within the banking system. To understand how Fed can create money within the banking system, we must understand how the depository institutions respond to Fed action that increase reserves in the entire system. And for that, we have to understand Fed's open market operation. Open market operation is a Fed's purchase and sale of existing US government securities in the open market, the private secondary market in which people can exchange securities that have not yet matured. Assume that Fed engaged in open market purchase by purchasing 100,000 US security from a bond dealer. The Fed does this by electronically transferring $100,000 to the bond dealer's transaction deposits at Bank 1. Here you can see, as shown in balance sheet 15.2, Bank 1's transaction deposit liabilities increased by $100,000. Let us suppose that the reserve ratio for Bank 1 and other depository institutions is 10%. As shown in the balance sheet 15.2, Bank 1 responds to this $100,000 increase in transaction deposits by adding 10% of this amount, or $10,000, to its reserves. Bank allocates remaining 90,000 of the additional deposits to new loans. So its loans increase by 90,000. At this point, Fed's purchase of $100,000 US security from the bond dealer has increased the money supply immediately by $100,000, and this occurs because transaction deposits held by the public, that is the bond dealers, are a part of money supply. We can say that the addition of $100,000 to deposit with Bank 1 with no corresponding deposit reduction anywhere else in the banking system increases the money supply by $100,000. If another member of the public instead of Fed has increased the purchase of bond, that person's transaction deposit would have reduced by $100,000 and there would have been no change in the money supply. The process of money creation does not stop here. The borrower who receives 90,000 loan from Bank 1 will spend this fund, which will then be deposited in other banks. For example, suppose $90,000 was spent by Bank 1 borrower is deposited in the transaction deposit account at Bank 2. At this bank, as you can see here in the balance sheet of 15.3, transaction deposits, hence money supply increased by 90,000. Bank 2 adds 10% of these deposits, or 9,000, to its reserves. It uses remaining 81,000 of the new deposits to add 81,000 to its loan. And this, this deposit creation process continues. You can look at Bank 3's account in the balance sheet 15.4. Assume that the borrower is receiving 81,000 loan from Bank 2 and spends this fund, which then are deposited at Bank 3. Transaction deposits and money supply increase by 81,000. Reserves of Bank 3 rise by 10% of the amount, that is $8,100. Bank 3 uses the rest of the newly deposited funds, or 72,900, to increase its loans. The process continues to Bank 4, 5, 6, and so on. Each bank obtains smaller and smaller increases in the bank deposits because bank holds 10% of the new deposits as reserves. So each succeeding banks makes correspondingly smaller loans. Have a look at the table 15.3 that shows the maximum money creation with 10% reserve ratio. This table shows the maximum new loans that the bank can make given the Fed's electronic transfer of $100,000 to a transaction deposit account at Bank 1. Remember, the reserve ratio is 10%. So you can see here in this table, first in Bank 1, there was like $100,000 and they kept 10% of the reserve, that is 10,000. The remaining was 90,000 that the amount of maximum loan can, they can give to other banks. So they gave 90,000 to Bank 2. From 90,000, again 10% was kept as reserve, which is now 9,000. The difference between the two is 81,000, which is the maximum new loan that they can offer. And they gave loan to Bank 3 as 81,000 of the loan, and that pattern continued with a total of 1 million of new deposits. So the table 15.3 shows the new deposits, reserves, and loans for the remaining institutions or banks. And every time, you can also observe here, each bank obtains smaller and smaller increases in deposits because bank hold 10% of the new deposits as reserves. Thus, each succeeding depository institution make correspondingly smaller loans. Have a look at the figure 15.7. It shows the multiple expansion in the money supply due to 100,000 in new reserves when the reserve ratio is 10%. The banks are all aligned in decreasing order of new deposits created. Bank 1 receives $100,000 in new reserves and lent out $90,000. Bank 2 receives $90,000 and lends out $81,000. The process continues through Bank 3 to 19 and then the rest of the banking system. Ultimately, assuming no leakages into currency, the $100,000 of new reserves results in an increase in money supply of 1 million or 10 times the new reserves because the reserve ratio is 10%. What is a money multiplier? It is a number that when multiplied by a change in reserves in the banking system yields the resulting change in the money supply. So let us consider an example. In the example that we are discussing, say $100,000 increase in the reserves, which is generated by Fed's purchase of security. Security can be like your bonds, right? Yielded a 1 million increase in the transaction deposits, and hence that leads to increase in the money supply. So we can say deposits and the money supply increased by a multiple of 10 times the initial $100,000 increase in the overall reserves. Similarly, a 100,000 decrease in the reserves generated by the Fed's sale of security or sale of bond will yield a decrease in the total deposits of 1 million. That is a multiple of 10 times the initial $100,000 decrease in the overall reserves. So, we can generalize about the extent to which the total money supply will change when the banking system reserves are increased or decreased. The money multiplier gives the change in the money supply due to change in reserves. When the reserves increase, money supply increases. When reserve decrease, money supply decreases. And here in this example, the value of money multiplier is 10. Write on the discussion board, how will a new regulatory policy affect money multiplier? Now let us discuss about the potential versus actual money multipliers. If we assume that in our example, all the loan proceeds are deposited with banks, we obtain the potential money multiplier, that is the maximum possible value of the money multiplier. As you can see here, the potential money multiplier is the reciprocal of the reserve ratio, that is 1 divided by the required reserve ratio. So the potential multiplier is equal to 1 divided the fraction of the transaction deposits that the banks holds as reserves. Here in this example, the reserve ratio was 10%, or we can say 0.10 as expressed in decimal fraction. Thus, in this example, the value of potential money multiplier was equal to 1 divided by 10%, which equals 10. What happens if the entire amount of the loan from the depository institution is not redeposited? When borrowers want to hold a portion of their loans as currency outside the banking system, these funds cannot be held by banks as reserves from which to make loans. The greater the amount of cash leakage, the smaller the actual money multiplier. Typically, borrowers do hold a portion of loans proceed as currency. So, the actual money multiplier usually is smaller than the potential money multiplier. Now, I'll talk about the real world money multipliers. The potential money multiplier is rarely attained for the banking system as a whole. Each definition of money supply, that is M1 or M2, will result in a different actual money multiplier. In most recent years, the actual M1 multiplier has been in a range between 1 and 3. The actual M2 multiplier showed an upward trend until recently, rising from 6.5 in the 1960s to over 12 in the mid 2000s. Since then, it has dropped to about 4. Thank you for all of your kind participation. If you have any questions, feel free to ask me via Zoom, or you can write your questions on the Google Doc that I have shared with you.